Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to review how to pay bills with the line of credit. So this is a very important concept in velocity banking where you put your paycheck into the line of credit, pay your expenses out of line of credit. And if you have no idea what I'm talking about, what velocity banking is, go ahead and click the link to Velocity Banking 101 down below, and then come back here to continue your studies. And so just to kind of make a point about, paying your bills out of line of credit, I think what happens is that a lot of people get confused by the term, line of credit because it's not as commonly used as, let's say, a credit card, even though a credit card is a line of credit, right? So just to give a brief explanation of what a line of credit is, all it is a financial tool where you can borrow money, pay back, reuse it over and over again, right? And that's essentially what a credit card is. But there are different types of lines of credit. So when I talk about line of credit here, that is actually a little bit different from, let's say, a credit card because that's describing a personal, business, or home equity line of credit. And the minor difference between those types of line of credit or lines of credit versus a credit card, even though a credit card is a line of credit, is that um, with a personal line of credit, let's say you click a button on your bank's website and you withdraw, I don't know, $500 of cash into your checking account, borrowing at a 15% interest rate. The moment that you click that button and you withdraw cash from the line of credit, you're being charged interest no matter what, right? Whereas with a credit card, you get charged interest usually only if you carry a statement balance to the next month, right? So just call your credit card company or your lender or whatever and ask them like, hey, how do I make sure that even though I have a balance, how do I make sure that I don't get charged interest? And the answer they'll usually give you is that if you pay your statement balance off in full, they won't charge you interest, right? But always verify with the terms and conditions of your credit card company to figure out whether you're going to pay interest or not. So back to here. So there's going to be several scenarios that I'm going to review. So let's say we have access to a credit card and a personal line of credit, right? So this is my most preferred method of paying bills with the line of credit. So what's going to happen is that you're going to pay all your bills with a credit card, right? Because assuming that you're not going to carry a balance, you pay all your bills, and once that statement due date comes, then you just pay off of your line of credit, assuming that you're using velocity banking to pay off your other bills. Now, if you didn't have any other debt with your personal line of credit or HELOC or whatever, you don't really need to use the line of credit. But we're going to assume that you're paying your bills with your credit card and you can pay it off in full, and you have other debts you may have consolidated, like the student and auto loan, into that line of credit. So again, this is my preferred strategy: pay all the bills with the credit card. Why? Because I can delay the interest by holding my bills in the credit card, just as long as I pay it off in full. Then once I pull out money from the line of credit, then that's when I'll start to be charged interest, right? So with velocity banking, you put your paycheck in, it comes to your checking account, and then the moment it goes to the checking account, then you dump it into the line of credit, and then that's going to satisfy the payment as well as minimize the daily interest, because the interest is calculated by the average daily balance. And then what happens is that when that credit card statement is due, you pull out money from the line of credit to the checking account, and then just pay your credit card from that checking account. Well, hopefully the statement in full, so that you don't get charged interest, right? So that's how I would pay bills with the line of credit. Again, you need a checking account usually, right? I'm not saying get rid of your checking account. The only difference between what I call the velocity banking situation and the average American situation is what's your operating account. Is it the line of credit, or is it checking account, right? And so the source of funds will eventually come from the line of credit back to the checking account, and then you pay your credit card statement in full. So that's my preferred method of paying bills. Again, not giving you direct personal or financial advice. Speak to a lawyer or financial advisor or someone who's licensed or has credentials that people would recognize. Okay. Now the next situation is, let's say you had a credit card only, right? You don't have any lines of credit. What I would do is just pay all the bills with the credit card, right? Just pay all the bills with the credit card, and then as soon as you get your paycheck into your checking account, dump it on the credit card. Now this is assuming you don't have any bills that you have to pay in cash, and so like a mortgage or anything like that. But if you did, just reserve. Don't put that amount in that credit card. But it's really easy with the credit card. You pay all your bills with the credit card, and then you dump your paycheck into credit card from your checking account, and that's it, right? So it's a little bit simpler. This is a little bit more if you're being strategic with your debt and you have to carry a balance on your line of credit, such as maybe you're consolidating loans to free up the cash flow. But this is again my preferred method. But you don't have it. Let's say you don't have access to a line of credit, then you just do this with the credit card only, and then just leave out the stuff that you have to pay in cash. Okay. So number three, this is my least preferred method of using a line of credit only. And I'll tell you why, right? So what's really annoying of, let's say, having a personal line of credit or a HELOC is that usually you don't have card access to pay for things from that line of credit, although that's not exactly true, right? So for example, with the HELOC, they actually gave me a credit card to charge things onto the HELOC directly rather than from the checking account. But why would I rather use a credit card from one of the standard issuers like Chase or Discover than a credit card from a HELOC? Because if I use a credit card from a HELOC, the moment that I use that card, they're charging me interest. Whereas if I use like a regular credit card like Discover, then as long as I pay the balance in full, again, talk to your lender to see if that's true, then they're not going to charge me interest, right? But let's just assume that we have a personal line of credit with no card access, because the personal line of credit that I have, they never give me like a debit card or a credit card or anything like that. So basically, this is what I would do. I put my paycheck into the line of credit. I pull out money from the line of credit to the checking account to pay a bill, and then I pay from the checking account. Now, why is this annoying? Because every single time that there's a bill due, I have to pull out money, right? So maybe I have 5 bills due, and I'm trying to time it, and now I have to time every single transfer from the line of credit to the checking account. And again, that's really annoying, right? So that's why this is my least preferred method. Whereas using this combo, yeah, I want the flexibility of line of credit, but I just want to make one payment to a credit card if possible. Okay. This one is a preferred method as well, because again, I just have to make one payment where I just dump my paycheck into the credit card. Whereas this one, let's say I have 5 bills, then I have to pull out the money from the line of credit 5 separate times, and it's just like, oh, such a hassle, and I'll probably forget and miss a bill, and I really don't want to do that, right? So again, these are the 3 main situations that I can think of where how I would pay bills with the line of credit. So it may not be so obvious. Yes, you do need a checking account for that, because the checking account is going to pay off one of the bills. So this one, you're using a checking account. The source of funds is from the line of credit, right? It goes to the checking account, and then you pay off your credit card statement, hopefully in full. Okay. And then here, checking account to credit card, dump all your income into that credit card, and then pay your expenses out of that credit card. And then here, if you have a line of credit, you dump your paycheck in the line of credit, and then every single time a bill is due, then you gotta take out that bill and put it back into the checking account, and then pay from that checking account. Okay, so I hope this was helpful. If you have any questions, comments down below. And if you're interested in joining our group for mentorship, go ahead and click the Google form link below, submit your information, and we'll give you a contact for a Zoom intro meeting. Also, you can email us by going to the About page of the YouTube channel. Have a great day, and we will speak next time.